Welcome back. I'm Ahmed Pirzada, and this video is part of the MSc unit on International Finance and Economics at the University of Bristol. So in this session, we are going to focus on the 2008 financial crisis, and we're going to see how is it that the crisis originated, and how did the central banks respond in order to mitigate the effects of the crisis on the economy. But before that, let's quickly have a look at the two major financial crises we had over the last 1 century. So one was the crisis or the Great Depression in the 30s, and that's given by the blue line over here. And the second one was the 2008 financial crisis, which is given by the orange line here. So note two things. One, both the crises, they started off in a similar fashion. But later on, you can see when it comes to the Great Depression, the world industrial production, which is what is plotted here, it contracted a lot more and kept on falling for a much longer period of time. Whereas when we look at the 2008 financial crisis, it recovered much quicker. So the question we then should ask is, why is it that the recovery happened so quickly in the case of the 2008 financial crisis compared to the Great Depression in the 30s? Another thing to note as well is that both the crises were very similar in nature. These were both financial crises. Both of them were preceded by an increase in borrowing by the households and the firms. And essentially, the collapse was also very similar with respect to that they were characterized by bank runs and defaults. So why is it that when the two crises were so similar, they ended up having very different implications for the economy? And the answer to that is how the policymakers responded to the crisis. So one is obviously the fiscal policy. The second aspect, which is what we are going to focus on in this session, is the monetary policy. So one thing to note is, so this figure plots the average interest rate in the 7 countries, the 7 most advanced economies, again, for the Great Depression and also for the financial crisis. The first thing you should note is that the decrease in the interest rate is rather quite similar, both in the 30s and also in the financial crisis, in the 2008 financial crisis. The one key difference is that during the Great Depression, the central banks then started to increase the interest rates from 1931 onwards, before they realized that they had made a mistake, and then they decreased it again later in 1933. This time, the central banks, they did not make such a mistake. They kept interest rates low for a much longer period of time and essentially allowed the economy to recover before they started on increasing the interest rates, for example, in the US or in the UK. But more importantly, there was something else which the central banks did this time, which wasn't done at such a large scale back in the 30s, and that is the nature of the unconventional monetary policy. So you see over here that when this is for the UK, this is the Bank of England. When the interest rates hit the zero lower bound in mid 2008, you can see, and this over here, this figure plots the asset side of the balance sheet of the Bank of England. So you can see over here that the balance sheet started to look very different after this point in time. This is when the economy hit the zero lower bound. But before I explain what was happening, let me explain what this means. So this graph over here shows you the type of assets the central bank currently has on her balance sheet. So if you recall the previous video, the way we were discussing the monetary policy was, in order to make sure that the central bank is able to keep the interest rate at the desired level, the central bank ends up buying or selling securities from the financial system to make sure that the banking system or the financial system has enough liquidity to sustain the level of interest rate which the central bank is targeting. And those securities which the central bank buys and sells from the financial system in order to achieve the target level of interest rate, those are the securities which are displayed over here. So you can see over here, before the financial crisis, most of the securities or a much bigger chunk of the securities is made up of short-term government bonds. So the central bank buys, in most of the cases, buys a large quantity of short-term government bonds to make sure that the short-term interest rate, or to achieve the target level of the short-term interest rate. They also lend directly to the government. They also invest. Sometimes they also buy long-term bonds or securities to make sure that the markets have enough liquidity to sustain the new loans which have been created in the equilibrium. But note over here, from this point onwards, the share of short-term securities almost goes to zero. Why? Because then that doesn't really help much, because you can buy short-term securities, but they will not help in lowering the short-term interest rate any further. Rather, the central bank starts buying the long-term securities, right, which is given by this orange area over here. And the idea is very similar to what we discussed in the previous video when we were talking about QE, the quantitative easing. Now the central bank was buying the long-term government bonds directly to make sure to influence the long-term borrowing cost directly. And as we move forward in time, the central bank, that fades away. And then the central bank starts buying a lot of other assets. And these other assets include mortgage-backed securities and so on. So we'll see later why is it that the central bank started buying mortgage-backed securities, and why did it help at all? But note another thing, that's one. The other thing you should also note is that the scale at which the central bank or the Bank of England was buying these securities or buying these assets from the banking system, that increased by about 4 times in a span of just 5 years. And we see the same thing happening in the US as well. Was it useful? So there's a paper by Wu and Jia, and it turns out that doing this by engaging in buying these securities, the mortgage-backed securities, the long-term government bonds, more recently even highly rated corporate bonds, and so on, it turns out doing all of that has helped in improving the borrowing conditions, has helped in easing the borrowing conditions. So remember, the central bank can no longer decrease the interest rate below zero in most cases, or cannot decrease the interest rate below a certain threshold. That threshold might be zero, might be -1, depending on which country you're looking at. So even though they can't do it, but doing everything else, doing everything we were just discussing, that essentially meant, or that was similar to decreasing the interest rate or taking the interest rate or the short-term interest rate in the negative territory. So all of that was essentially similar to decreasing the interest rate all the way to -4% here in 2014. So this essentially shows that all of this activity, which was being done by the central banks after the financial crisis, it did help in easing or in significantly easing the borrowing conditions which were prevailing in the economy after the financial crisis. So given that now we have an overview of what was happening, what were the central banks doing exactly, what type of assets they were buying, and perhaps why. Now let's move on to the crisis. Now let's dig into it and see why the crisis happened, and why is it that the central banks had to buy these assets, and what were they trying to achieve, to be a bit more specific. And let's again start from our basic, the balance sheet analysis. So let's assume that this is the balance sheet of the banking system. Over here, you've got assets, all the assets the banking system holds on their balance sheet, the liabilities, and then the net worth. So these numbers are arbitrary. I've just assumed them in order to illustrate in a better way. So let's say that the total assets are worth 100 million, liabilities are worth 94 million, and the net worth is 6 million, right? Don't take these numbers seriously. You can assume any other set of numbers, but this is just there to illustrate, to give you an example of how things will change as we proceed. The other thing to note is the type of assets the banking system or the financial system was holding on its balance sheet. One is obviously cash and reserves. This is what they have to hold in order to meet the liquidity requirements of their depositors. of the banks from whom they have borrowed money or from anywhere they have borrowed the money. Other assets include the loans they have issued to the customers, to firms, households, other businesses, other financial institutions, and so on. The loans they have given to each other from one bank to from bank A to bank B. Any other assets they have bought. So let's say many of the banks also hold or also invest in financial assets, for example, in mortgage-backed securities, in corporate bonds, and in other things. So all of those are also there on the asset side of the balance sheet. Now, before we move on to the crisis, it's also very, very important to appreciate what type of assets were these. And it turns out that these assets were not just the assets based in your country. It's not just that the financial system in the UK is only holding those assets which are or which originated in the UK, but rather these assets are actually from all over the world. So look at this. This is, remember, over the last 20, 30 years, the financial markets or the global financial markets have become very integrated. So there's capital flowing in, there's capital flowing out in large quantities. So people are investing in your countries, buying your assets, you are investing in other countries, buying their assets, and there's a significant increase in cross-border capital flows. And this figure plots an indicator of it. So this is essentially the sum of gross outflows and the gross inflows as a proportion of their GDP. So the blue line over here represents industrial economies, the advanced economies, and the red line is for the emerging and the developing economies. So you can see over here, compared to mid-80s, when the sum of gross inflows and outflows was equivalent to the size of the GDP of these advanced economies. So it has almost increased from 100 in mid-80s all the way to more than 300 just before the financial crisis. So this is essentially saying that the financial institutions or the private sector or agents in different economies, they're holding a lot more of foreign assets on their balance sheets. Why is that important? That's important because then if you are holding assets which originated in, let's say, some other country, then if anything goes wrong in that country and the asset value or the value of the asset which originated in country X gets affected, obviously, as a result, then that is also going to have an effect on my financial position because it's going to weaken the asset side of my balance sheet, which is then going to erode my net worth. My share prices are going to fall, my profits will probably fall, and that can also, if the shock is big enough, it can trigger a crisis in my home country as well as a result. The same thing is true for emerging economies as well, but at a much smaller scale. They have become a lot more integrated as well, but the increase is only half as much as what it was back in mid-80s. Another thing to keep in mind is when you're holding foreign assets, then if there's a large fluctuation in the exchange rate, that also has an effect on the value of that asset in your domestic currency. So for example, here, if your liabilities are in sterlings and some of the assets you hold over here, they are in dollars, because let's say you bought some of the mortgage-backed securities which originated in the US, then if the sterling moves up and down, that is also going to have an effect on the sterling value of these assets you're holding. So sharp fluctuations in the exchange rate, which are not that common for advanced economies. This is a much bigger problem for developing or emerging economies. But in any case, the principle should be kept in mind that if there are very significant fluctuations in your exchange rate, then essentially that can have an effect on the value of assets you're holding here. And the same is true for liabilities. So let's say if you've borrowed money from abroad, right? So you owe $100 to someone. Okay? So you borrowed money from the financial markets in the US, let's say. And then all of a sudden the currency collapses. What does that mean? That essentially means that the sterling value of that $100 you have borrowed from the US markets, it's going to go up. So because of fluctuation in the exchange rate, then your liabilities are going to go up in terms of your local currency. And if your liabilities are, let's say, or if the assets are in a different currency and liabilities are in a different currency, then fluctuations in exchange rate can either make you much better than before or much worse than before, depending on the composition of your assets and liabilities. So that also creates an additional source of vulnerability in the financial system. Okay, now that we know how the balance sheet looks like for these banking institutions and what are the nature of assets they are holding, the nature of liabilities they might have on their balance sheet, and why is that important? Why is that important with respect to how a shock in one country ends up affecting a banking or a financial sector in another country? Given that now we have an understanding, let's move on towards thinking about the crisis. So a good way to think about the crisis is to think about what was happening just before the crisis started. And just to make life easier for us, let's assume for some reason people were thinking that the future is going to be bright. Everyone expects that in the future they will be earning higher income and therefore their purchasing power will be high enough to pay back any loan which they are going to take now. So if you're very optimistic about the future, about your future, about the country's future, then obviously what that means is households will end up borrowing more. You can also think of firms as well. So firms, households, they are all going to borrow more. So in that case, what that means is they are going to invest more, they are going to buy more assets, maybe they are going to buy more houses, more cars, more mobile phones, and so on. What does that mean? This increase in aggregate demand, both from the household side and the firm side, increases the value of assets. That can take a form of a housing bubble, it can take a form of an IT bubble, it can take a form of any other bubble, right? So that increase in asset price essentially then means that your balance sheet becomes much stronger. So now your assets or the assets you're holding, they are of a much bigger value than what they were just before this whole cycle started. And if your assets or the value of your assets has now increased and your liabilities have not changed that much, essentially what that means is that your leverage has gone down. And if your leverage has gone down, what that means is it's becoming much cheaper for you to borrow from the financial markets because you are a very safe borrower. And essentially what you see happening is when that happens, firms or households, they end up borrowing even more. And then the cycle just carries on. You borrow even more, that increases aggregate demand, even more, that increases the price of assets, even more, the leverage falls further. And as the leverage falls, you end up borrowing even more because it's even cheaper than before. And this cycle keeps on continuing, which ends up strengthening your balance sheet in the process. And the cycle just carries on until things fall apart. So here, for example, so as you're borrowing more and the asset prices are increasing because everyone is buying and investing in these assets, your firms are earning more profits. They are from engaging in because aggregate demand is high, and so on. So their cash holdings or new cash holdings go up as well because of the improvement or increase in cash flow in the form of profits, revenues, and so on. The asset prices are increasing, so asset prices go up. This could be mortgage-backed securities, this could be your housing assets, this could be any type of asset, physical or otherwise. So when all of these assets are going to go up, you can see that the asset side of the balance sheet is going to go up. If liabilities are not changing by much, what that essentially implies is that your net worth is going to go up. And as your net worth goes up, essentially what that means is that the share price, if your company is um, it's a public company, then the share price of the company is going to go up. Right? If the share price of the company goes up, then essentially the share price of a company is also the share is also an asset. So the cycle just carries on. It sort of fuels itself if no one intervenes to stop it at an earlier stage. And this keeps on happening until just the bubble bursts. At one stage, people realize that the expectations they had about their future income, that is not realizing, that is not materializing. So you can see over here that just before the crisis, before 2006, house prices in the US, they were increasing at an ever increasing rate. So just before the crisis in 2006, when things started to go bad, you can see that the housing prices in the US were actually increasing at a rate of 11%, at an annual rate of 11%. And then thereafter, things started to slow down. The expectations were not realizing. People started buying less of houses. Those who had already borrowed money, those who had already entered into mortgages or taken on mortgages, they were not able to pay back the payments which were getting due on their mortgages. The central bank or the Federal Reserve had already increased the interest rate from a much lower rate to almost 5%. So a sudden increase in borrowing costs essentially meant people were not able to pay back the loans they had taken from the market. So things then started to really go bad. And you can see all of a sudden, in a span of about 2 years, you can see that the growth rate in housing prices, the annual growth rate in housing prices in the US collapsed from around 11% in, in around 2006 all the way to negative 7.5% at the peak of the crisis. What else? As this happens, as households start struggling to pay back the loan they have taken in expectation that somehow their income levels are going to go up or will keep on going up in the future. As that happens, as this bubble bursts, what the next thing you see happening is that the ratio or the proportion of non-performing loans in the banking system starts increasing. And this is the graph for the US, for the UK, and for the Euro area. So the green line, the blue line is for the US, the green line is for the UK, and the purple line is for the Euro area. And you can see just around the same time when the bubble started to collapse, to burst, you can see that the ratio of the non-performing loans starts going up in all the three areas. So it went up from all the way to around to between 1 to 2% to between 4 to 5%. In the UK and the US, this then stabilized and then started declining thereafter, a bit faster in the US, less so in the UK, but they are not too different from each other. But in the euro area, this kept on worsening all the way till 2013. It increased almost twice as much as it did in the US and the UK. And you can see over here, even in 2016, if you see this chart, for many of the euro area countries, the ratio was much bigger. So overall, the euro area average for the non-performing loans in 2005 was 6%, okay? Or was even, if you look at this figure for 2016, it was around 5%. But for many of the countries in the euro area, this figure was much higher. For Greece, look at this, it's almost close to 50%. 50% of the portfolio, of the loan portfolio in the banking system, it's non-performing. The same for Cyprus. For Italy, it's around 20%. You might think it's low, but then when you compare it with the average in the euro area, this is almost 4 times as big. Okay, so you can already see in the euro area, the crisis is way worse than what it was in the US and the UK. Why is that? One reason why that is because in the US and the UK, both the governments, they increased their spending a lot more than what happened in the euro area, because euro area is a lot more complex, because it's a union of different countries, and they have to decide together, come together and decide together how much they want to spend, and that's a very difficult process. In for UK and US, it's a country which decides on its own, so there are less political constraints over there. So over there in the US and the UK, both the monetary policy and the fiscal policy was much more aggressive, and therefore was able to contain the crisis relatively sooner. Whereas in the euro area, both the monetary policy initially and also the fiscal policy were relatively less aggressive, and therefore the crisis worsened a lot more in the euro area than otherwise. So what does all this mean then? Let's come back to our balance sheet, and you see what this means is that the value of your assets start falling. One, because now the risk of your loan portfolio has increased because the ratio of non-performing loans has gone up. So the value of your assets, which are the loans you have issued to your customers, the value of these assets is going to go down. They're not worth as much as they were just before the non-performing loan, the proportion of non-performing loans started to go up, just before when the bubble burst. And likewise, as housing prices collapsed, then obviously the value of the mortgage-backed securities, which are essentially backed by these housing assets, that also went down. And because now the asset side of your balance sheet is now taking a hit, so you can now, and liability side is fixed because that's not changing, right? You still owe whatever you owe. That's not changing. So in that sense, essentially, what you can see is that this collapse or a drop in your asset on the asset in the asset side of your balance sheet, that's going to affect your net worth. And as your net worth falls, then what that obviously means is that your share price falls. What else? So as this is happening, as this process kicks in, what happens? What happens is that the risk that the banks will be able to meet the liquidity needs of their clients, that goes up. In other words, it becomes much more likely that there will be bank runs. People anticipate that because the net worth or the net worth of the banks or the banking system is taking a hit because the asset side is collapsing, banks may not have enough assets left or enough liquid assets left with them in order to meet the liquidity needs of the whole deposit base here. So you can see over here in this chart that you can see there were the shaded area here that represents the number of bank runs or the bank failures. And you can see before the crisis for almost 2 decades, there were no bank failures. And then all of a sudden, you can see as the housing bubble collapses, the number of bank failures, they increase. They almost jump to double digits. And this remains high for 2 years here, and then it comes down and takes a while before it goes to zero again. And at the same time, if you look at this black line here, this represents the financial condition of the banking system. And you can see that the financial stress in the banking system, that also worsened as a result. And this started worsening rather sooner, just around the same time when the housing bubbles went burst. So this started worsening. As it kept on worsening, then we started seeing bank runs. As we started seeing bank runs, things deteriorated even further. Now, another thing is this graph over here. This is the cost of borrowing from banks. This is the interbank. So when banks borrow from each other, so that is known as the interbank lending rate. What is the rate? What is the cost for the banks to borrow from each other? And you can see over here, just around the corner here, this is when the Lehman Brothers went burst. The cost of borrowing, the interbank lending rate, really shot up. What does this indicate? This indicate at this point in time, banks were not willing to lend to each other. They were demanding a much higher price for this. They were not, in other words, in many cases, they were just not willing to lend to each other. Bank A was not willing to lend to bank B, bank B was not willing to lend to bank C, and so on. Why is that? That is essentially because first, their profits are falling. If the profits are falling, they don't have enough cash flow or they don't anticipate enough cash flow in future. Second, depositors are panicking, so they are running to the banks to withdraw their deposits in the fear that they may end up seeing a bank run, and in that case, all their deposits will disappear unless there is some sort of insurance there. And what all of that means is that the banking system really needs liquid reserves. They need cash and reserve balances at the central bank so that they can meet the liquidity requirements of their deposit base or of their customers. And you can see over here, in order to make that happen, they are going to recall the loans they had issued to other banks. Or if they were already maturing, they will not renew the loans they had issued to other banks. So all of a sudden, all the banks, they just stop lending to each other, or wherever they have already lent, they just start calling the money back. And that creates a problem for everyone, because now everyone is running out of cash, because they're all trying to somehow figure out how to get more cash, how to get more liquid assets, so that they can meet the need of this of the customer base, or whoever they are liable to. And you can see in the process, they run out of their cash balances, they run out of their reserves, because people are withdrawing money. Banks are calling their loans back, or they are no longer renewing their loans. And in order to figure this, we already know that the asset prices are falling, other asset prices are falling as well, like share prices are falling, businesses are going bust. So if anyone had invested in other businesses, so the value of those assets is falling as well. So it's a crisis which is literally affecting everything now. And also in the process now, because everyone needs cash and reserve, because they are just going to run to zero, what they are going to do is, on top of recalling the loans they had given to or issued to other banks, they're also going to start selling some of their assets. So you can call this is also known as the fire sale. So you start selling your assets because, one, either you need more cash, or maybe you think that the value of these assets is going to keep on falling, so it might be better to exit the market or to liquidate your assets sooner before anyone else does, right? And in this process, if everyone is for doing this, if everyone is trying to figure out how to generate more cash or liquid resources, and at the same time, if everyone anticipates that these assets are going to fall, or the value of these assets is going to fall, so everyone is just trying to fire sell, essentially that just amplifies the crisis, because everyone is selling. So now the price of those assets is just going to fall even more than what it would have if some of the people had not, or most of the people had not been selling, because of these reasons we are discussing here. And in this process, you can see this might get so worse that your net worth just depletes. You're now underwater. Your assets are now less than your liabilities. And essentially why? And in this process, and this is why this is happening, the initial crisis actually took us here, right? Here. This is the first thing which happened. Your net worth decreased. Depositors panicked. They started withdrawing their deposits. Banks started to recall the loans they had issued. Banks, or the financial system, or the individual banks, they were running out of cash or liquid resources to meet the needs of their deposit base. They started selling the assets they were holding to generate additional liquid resources to meet the needs of their deposit base, or their or other banks, or whoever they are liable to. Some of the banks are also selling the assets because they think that the value of assets is going to fall, so it's better to just sell them. In the process, the value of the assets fall even more. And as this happens, that may end up depleting the net worth of the banks. If people come to know of that the bank net worth has just been depleted, they will withdraw even more than what they were doing before. Banks will recall their own loans with an even greater urge. Um, and that can lead to a further decline in the asset values. So the crisis or the recession becomes a depression. And this is what we saw happening during the Great Depression of the 30s. More so, worse than this, what happens is now banks, because they're running out of assets and because they want to meet the needs of their deposit base, or of their clients' customer base, they start withdrawing or recalling the loans they had issued to businesses, to households. And that's very harmful for the economy, because those loans were issued to projects which were perhaps worthwhile. Some of those projects are worthwhile to undertake, because they are going to enhance the productivity of the economy. But if you start recalling loans from such businesses, from such corporations, from such investment ventures, then essentially those investment projects, those infrastructure projects, those productive investments taken, undertaking R&D and all those things, those will stop. And as those stop, then the economy, or the productive capacity of the economy, starts taking a hit as well. So all of a sudden, it's no longer just the financial crisis. It is now becoming this financial crisis is now turning into a depression. It's now affecting not just the financial system, but also the real economy, but also the productive potential of the economy itself. So, what made the financial crisis so different? And essentially, it was all about the unconventional monetary policy. So, see what is happening. The crisis is originating in the housing market, and the housing market is directly linked with the mortgage backed securities. So, the value of the mortgage backed securities is the first thing which is going to take a hit. And the loans, obviously, you have issued to your customers who are in the housing sector for mortgage, you can say the mortgages you have issued, obviously, that's going to take a hit. So the central bank intervened, and the central bank says, okay, so in order to stop the recession to turn into a depression, the central bank starts buying these mortgage-backed securities. And in buying the mortgage-backed securities, the central bank credits the reserve balances of the financial system, of the banking system. So now you can start making sense of the first two graphs I showed you for the UK, for the Bank of England, and also for the US, that why is it that the central banks were buying, rather than buying government bonds, just government bonds, why is it that they were buying mortgage-backed securities? Because they were trying to make sure that the value of the mortgage-backed securities does not collapse altogether. So they were trying to support those prices. And in the process, they were also providing, in exchange for these assets, they were providing additional liquidity to the financial system so that the financial system is able to meet the liquidity needs, both of their depositors, of any other players in the financial system, and so on. Is this what the story I've just told you? Is this really true? Is this really what they did? Is this really what they had in their mind when they were implementing all this? Yes, indeed. So here's a statement from ECB. Let me read it, and you'll now understand this statement much better than if you had read it without going through these sessions. So the ECB says the significant increase in excess central bank liquidity in the euro area was necessary to offset the contractive impact of elevated liquidity stress on banks' balance sheets. So essentially, the ECB is saying that the need to engage in such large scale, in a such large scale, to undertake quantitative easing, buying government bonds, long-term government bonds, buying mortgage-backed securities, more recently even buying corporate bonds of which are of high grade. Um, the reason, the need for that was because the financial system needed liquidity to meet the liquidity requirements of their deposit base, of their clients, and so on. Right? So that was, so the stress which the banks or the banking system was facing, that made it essential for the central banks to engage in liquidity, in providing liquidity at such a massive scale. If this hadn't been done, then this could otherwise have led to abrupt asset sales. So if they don't have any source, if the banking system cannot get access to liquid resources, then how will they generate it? They'll either recall their own loans, which is again not good, or they'll sell their assets to generate, to get cash, or to even escape the cycle, or to basically sell their assets before anyone else does, so that they are able to liquidate their assets before they become worthless. So could have otherwise, if they had not done this, this could have otherwise led to abrupt asset sales and a curtailment of credit, with potentially severe consequences for the real economy. Because if you start recalling the loans, if you stop issuing new loans, essentially now it's no longer about the financial system. Now it's really affecting the productive potential of your economy. It's really affecting the real economy now. So with this, we conclude. So I think after in these first 2 weeks, now you have got a much better understanding of how the banking system works, how it allocates resources across the economy, why the crisis happened, how the central banks intervened, what was the rationale for quantitative easing and such unconventional monetary policies at such a large scale. Yeah. So let's wind it here. So take care, and I'll see you soon. Until then, bye-bye.